Hi everybody, Professor J here, and before we can talk about how to depreciate an asset, we have to figure out what costs are depreciable. So this first video is going to address that, and I'm going to give a couple of examples so that it becomes very clear to you what costs are depreciable. First of all, to determine what costs are depreciable, we have to ensure that the asset is, number one, it has to be a tangible asset. Well, what's a tangible asset mean? A tangible asset is one that you can kick. It has physical substance. You can use your five senses to see, smell, taste. Not that you're going to go around licking equipment, but hey, it could happen. Tangible assets are expensed over their useful life because we're only talking about long-term tangible assets as well. We're not talking about short-term office supplies that we expect to use up within 1 year. We're talking long-term assets. When you buy a car, you expect it to last longer than 9 months, or a year. So it's a long-term asset, and these are the only ones that depreciate and are not expensed right away. They're expensed over their expected useful life. So, number one, they have to be tangible. Number two, they have to be a long-term asset. Okay, if there are tangible assets, there are also intangible assets. So let me clear up right now what is an intangible asset. An intangible asset has no physical substance. You can't kick it. And I'm going to give you some examples here. Intangible assets would be something like patents, or a trademark, or a copyright, internet domain names, customer lists, like what Facebook has that everyone says is so valuable, the big customer list, pictures of, for example, a stock photography site, franchise agreements, drilling rights, computer software, trade secrets like secret recipes. Auntie Anne's pretzel recipe would be a trade secret that they're not going to give out, and it has value, but it's intangible. And the one that we're going to talk about later is the discount or premium on bonds payable is also an intangible of sorts that we are going to have to not depreciate, but amortize. Amortize is sort of the same as depreciation, but on an intangible asset. So we're going to talk about that later. Right now, we're just talking about depreciation on tangible assets, long-term tangible assets. So number one, once it's tangible and you know it's long-term, what exactly is a depreciable cost of that long-term tangible asset? It's not as easy as you think. So I'm going to give you an example. Here is some data about some land we just bought. The land we paid for with $150,000 of cash down and $150K of a note payable. We had to pay some delinquent property tax of $2,000, title insurance of $2,000. We had to level the land before we could use it, and we had to remove an unwanted building that was on the land. All of these cost us some money. Then, before we could build our office building, we had to add some soil for the foundation, pour the foundation, and then construct the building. After we did that, we installed a fence for $65K, a company sign, and we put some lighting on the grounds. So these are some of the expenses we had. But here's the thing. We have to identify what costs go into what account and which costs are depreciable costs. So, first step. Let me draw a little line here to separate the data from the result. There are three accounts that these are going to go into. The first one is the land account. The second one is the building account. We're going to have an asset called land. We're going to have an asset called building. But here's one you may not have heard of. We're also going to have an account called land improvements. So, now it's time to identify which of these costs go into which account. And this is very important because, first of all, land is never, ever, ever depreciated. So any anything that goes into the land account, we will not have a contra account called accumulated depreciation. It just won't have it. Those costs go down as our historical cost of land, and they just stay there at that value. So next to each one of these, we are going to identify, is it a land account, is it a building account, or a land improvement account type of entry. Well, all right. Before we begin, there is a rule you need to know. To identify what goes in what account, you have to say what costs are required to get that asset ready for its intended use. The term here is ready for use. Well, to acquire the land, we'd have to pay for its financing. So the land, regardless of how we paid for it, we could have paid cash, we could have paid note payable, or a mix, as you see here. Those costs will go into land. So that's $300K right there that will go into the land account. Property tax. Well, we're not going to be able to acquire the land if we don't pay that delinquent property tax that didn't get paid. So that goes into the cost of the land as well. We can't get the land if we don't pay the title insurance. So that goes into the cost of the land. Now we get a little different. Leveling the land. A lot of folks might think that's a land improvement, but it isn't. It's still considered a cost that is preparing the land for what we intend it for. What do we intend to do with that land? We intend to put an office building on it. But leveling the land is not a cost of the building. It's a cost of getting the land ready for its intended use. It's still getting the land ready for what we want it to do, which is host a building on it. Removing the unwanted building that's sitting there, that again is getting the land ready for its intended use, which is to build a building on it. We can't build a building on it with that unwanted one sitting there. So that's a land cost. Adding a soil for the foundation. A little tricky. This is getting it ready still to put a building on it. It's not a part of the building itself. So again, this is getting the land ready to put a building on it, adding the soil for the foundation. That one's a little tricky. Some people might put that as a building cost, but it really is not. It is getting it ready to put the land on it. So these are all land cost account. You add up all those costs, and that would go right here, and I think that ends up being $360,000 for the land if you add all that up. Building costs, pouring the foundation, that is a building cost. That's actually part of the building. So that's a building account. And then, of course, constructing the building is a building account. So this is going to be $1,050,000 go in the building account. Then we have land improvements, and that actually is the last three. These are not a cost of the building, and they're not a cost of the land either. They are a land improvement. So these last three, adding a fence, a company sign, a lighting, these are tangible assets that definitely are depreciable assets, and those end up being, I think, $81,000. So now you have three accounts, and that helps you figure out what costs are depreciable. Land is never a depreciable cost. However, building is depreciable cost, and land improvements are depreciable costs. So now that you know what's what, you've identified which costs are depreciable by putting them into the right account. Now we can go on to the different methods of actually depreciating those assets. We won't depreciate land, but we will depreciate our building and land improvements accounts. Real quick, one more example. Let's say you bought a giant candy making machine for $10,000. There are costs that get added into that. When you have your machine T account here, which costs are going to go in there and be depreciated, because this is a long-term tangible asset. Shipping gets added into that $10,000 right there, and let's say that was just $75. Interestingly enough, installation is a cost of getting that machine ready for its intended use. That $150 is a cost to that machine and a depreciable cost. Any taxes you paid on that, let's say you paid $150 in taxes, that gets in there as well. The insurance during shipping and getting it to you, that would be a depreciable cost as well. Not the insurance on the machine that you have after it's already functioning with its intended use of making candy, but the insurance that you paid on it in the shipping process. If you paid separate for that, that's a depreciable cost as well, because it's part of getting the machine ready for its intended use. You may have to pay to have the machine calibrated. So any calibration costs. Now, that could be part of the installation cost as well, but if it was separate, you could add it. Let's see, 30 and 25 would get added. And maybe the installers of this giant candy making machine showed up and your floor was not the right kind of concrete. This machine creates vibrations, and they have to pour a new concrete floor made of a special type that won't break up under the vibrations of the machine, and they charge you another $200 for that. That's extra installation fees on top of what you expected. Pour some new concrete. That would be a part of getting it ready for its intended use. And so the cost of that machine, the depreciable cost, would be $10,630, not just the $10,000 that you paid for it. So that's yet one more example of what costs are depreciable.